Hello, everyone, and good morning, good afternoon, or good evening, wherever you are in the world. My name is André Sapir. On behalf of Bruegel, I'm pleased to welcome you to this event on multilateral development banks. It is jointly organized by Bruegel and the Center for Global Development with the participation of the European Commission. MDBs have played a crucial role in fostering development for several decades now and throughout the world. Although generally successful, this task is not over yet, far from it. Development, and in particular sustainable development, remains a crucial mission for MDBs, which should continue to finance the provision of local, national, or regional public goods. More and more, however, MDBs are being called upon to also help addressing global challenges and to finance global public goods, such as climate and health. In many ways, this is a welcome development. But we should not minimize the economic, financial, and political implications and challenges associated with this new mission for the MDBs. Before turning to the extraordinary high-level and highly qualified panel that will address all of these questions, let me pass the floor to Elena Flores, Deputy DG at the Economics Directorate General of the European Commission, for her introductory remarks. Elena?
Many thanks. Good afternoon, everybody, and thanks to Bruegel and the Center for Development to co-organize this event. We are happy to be here and obviously to listen to this highly interesting and experienced panel. We are very much committed and attached to this discussion, in particular to the reform of MDBs and in particular to the financial capacity of MDBs. As most of you will know, this is not such a new discussion. It really started already some years ago because the challenges were already there. But I can point to the G20 already commitment to work on an action plan to optimize balance sheets back in 2015. And then obviously the report that the experts group led by Franny here in the panel put forward in July last year, review on MDB's capital adequacy framework, that really gave a push to this discussion. And even more so when last November, the leaders really endorsed that and called for moving forward with this work. The expectation now is that indeed MDBs, which are currently working on that, will deliver their first proposals at the time of the spring meetings, so very soon. And then the G20 will work on a roadmap to be endorsed by ministers in July. So we are really at the full speed on that work, and with, I would say, high expectations for delivery. Why? Because it's absolutely essential, as André Sapir pointed to, that MDBs are in a position to address old and new challenges and to have the necessary firepower to really make a difference, I would say. And it is very important that, in particular, the development of these capital adequacy framework recommendations should lead to have a higher impact in all the activities that MDBs are pursuing. So as I said, expectations are high. We know that many MDBs are working on that, and we will have some examples here today in the panel. We know that views are not necessarily 100% aligned because every MDB is different, but we are also convinced that MDBs need to make progress as a system of MDBs in moving forward with these recommendations and also in working together in order to make such an MDB system really as impactful as possible in the provision of the development goals and in addressing the global challenges. So with this, I don't want to take more of the time because we are very interested in listening to the person that has led this work for the report, but also to some of the MDBs and to the G20 presidency to see how they are moving forward with this work. Thank you very much for joining today, and thanks to the panel.
Thanks so much, Andre and Elena. It's a pleasure to join this conversation. I'm Nancy Lee, Senior Policy Fellow at the Center for Global Development and Director for Sustainable Development Finance. And I'm very happy to be part of this discussion, first of all, because it includes our very distinguished Capital Adequacy Panel Chair, Franny Leautier, CEO of Southbridge Group, an investment and advisory company. Let me say publicly what all the panel members would tell you privately, which is that Franny has been an enormously effective and skillful chair. And the traction that this report is getting is in no small measure due to her. We are also fortunate to have two critically important MDB shareholders, Alexia Latortu, Assistant Secretary for International Trade and Development from the US Treasury, and Ajay Seth, Secretary of the Department of Economic Affairs of India's Finance Ministry. And we have the two largest European multilateral development banks represented, Soha El-Turki, Vice President and Chief Financial Officer of the EBRD, and Andre Mates, Head of the Capital Management Division of EIB. So let me just make three basically practical points before I turn the floor over to Franny. It's as Elena said, expectations are high. And I think one of the most important things is that we avoid getting into a fruitless debate over which we need more efficient use of capital, or in some cases, more capital in the form of general capital increases. We have some sense of the scale of development and climate finance needs based on a growing number of analyses. The most recent, the Songway Stern report, for example, found that an additional $1 trillion of finance is needed for the climate investments of the developing world alone. So given that scale, it's obvious that we need both the capital adequacy reforms and in relevant cases to begin consideration of capital increases, and they reinforce each other. Of course, using every dollar of capital more efficiently means that general capital increases will have much greater impact. The second point is that the panel has recommended steps that can be taken this year to meet some of these expectations that Elena was referring to. And the World Bank is already considering changes in equity to loan ratios that could increase annual lending by about a third. And that's without implementation of a number of the additional capital adequacy recommendations. Two other panelists and I, Chris Humphrey and Hans-Peter Lankus, recently just suggested 6 near-term steps, either to begin to develop implementation plans or to do the analysis needed to assess the steps for changes in capital adequacy methodologies. So these reforms can move forward quickly and more quickly in practical terms than capital increases. And the panel deliberately chose actions that do not change MDB governance or shareholding structures. Nearly all of them do not require changes in the Articles of Agreement. They're broadly applicable across the institutions, and the financial innovation proposals have been piloted by one or more institutions. So what I would stress, the importance for both shareholders and MDB management of acting quickly to demonstrate that the system is capable of rising to these challenges that we all are aware of. And finally, one last point. We know that private investors and wealth managers controlling trillions of dollars, more than the MDBs will ever have on their balance sheets, profess their intent to increase the share of SDG investments on their portfolios. Part of the panel's work was to propose portfolio level transactions that would give these investors opportunities to invest in MDB assets at scale. So it's important to bear in mind that the recommendations very much relate to mobilizing more investment, more private SDG investment, as well as increasing the lending on the MDB balance sheets themselves. So with that quick introduction, let me turn the floor over to Franny to give us an overview of the report.
Thank you very much, Nancy, for that brilliant introduction. Good morning, good afternoon, good evening to everyone participating in this call. And thank you very much to the Bruegel Institute and Andre in particular for inviting us to discuss the report here along with the Center for Global Development, which Nancy represents. And I appreciate very much the remarks made by Elena, who basically also situated why this report that I'm going to talk to you about was important to do. So maybe just very briefly, to let you know how we came about as a panel. We were launched when Italy was the president of the G20. Our work took place when Indonesia was the president of the G20, and implementation is now taking place under the presidency of the G20 of India. And that shows you how important this topic is because it has survived 3 presidencies. And I think this is really significant to mention. Secondly, I'd like to say that when we were launched as a panel, we were put together with a very incredible team of people who brought expertise from specific fields, first having worked, some of them for a number of years in different MDBs, and therefore understood the MDBs from the inside out. Others who had done research on the MDBs from an academic or think tank point of view, and therefore were familiar with the economic arguments, financial sector arguments, and other policy issues. But we also had people who had represented shareholders and therefore knew what the shareholders were thinking. And of course, people who engage with market participants and were familiar with what either the credit rating agencies thought about MDBs or what the markets were thinking and how they would react. So we had an excellent panel to look at these issues. The second thing that we did is we looked at the situation we were in. And of course, the world is facing challenges that it has never faced before at this scale. And that has a direct implication on how the MDBs function, because if we didn't have the MDBs, we would have to have created them because they are a unique vehicle to take liquidity from the market, use private sector solutions in an affordable way, and bring them to bear for development purposes. So that was a unique opportunity given the risks we were facing. And then the last thing I would say before I go into the recommendations of the report are that the challenges that the world is facing have shifted the pattern of risks that the MDBs have to deal with, the level or severity of those risks, and therefore the speed by which the MDBs have to act, but also the concentration of those risks, either geographically or sectorally, and therefore a need to really look at the whole approach that the MDBs use for capital allocation, for determination of risk, and also for their activities and the speed at which they engage, including with the private sector, as Nancy has so eloquently mentioned. So what did we come out with recommendations from our report? The first recommendation is precisely looking at that risk environment and arguing that really the shareholders should adopt and encourage the MDBs to adopt a more efficient management of capital and a different and more effective way of defining risk and risk tolerance in particular, because of the environment that I just mentioned. So that's our very first recommendation. And MDBs are now looking at that. We've had several discussions with risk and audit committees of different MDBs, and we are being invited to meet with even more. So there is a very active uptake on this recommendation because of the push from the shareholders to rethink the risk tolerance framework. The second block of recommendations would then to pick on the unique features of the MDBs. When the MDBs were created, most of the countries that founded the MDBs were themselves having a lot of difficulties because it was just after the Second World War. And therefore, they couldn't come up with all the public resources that were needed for reconstruction and development around the world. So the feature that was embedded in the design of the MDBs was a feature called callable capital, which is a collective commitment or a collective guarantee that the shareholders of the MDBs would be there should the MDBs need them in unique cases where they don't have sufficient capital to deal with the challenges that they're facing, and particularly with the obligations that they have to bondholders and others. So we basically thought that and studied the callable capital issue and recognized how powerful it is as an instrument for expressing this collective commitment, and therefore looking at whether the MDBs get full credit for that expression of commitment by the credit rating agencies, or whether that concept is as well understood by the market participants who then take risks or place their capital with the MDBs. So our recommendation there is that the MDBs should incorporate the financial benefits of that callable capital in the way in which they do their own capital adequacy assessments, and that for some of the MDBs are already doing that, like the Inter-American Development Bank, so the others could learn from that. And some credit rating agencies are already giving partial credit for that, so other credit agencies could look at that as well. The third block of recommendations was targeted at what has been mentioned earlier by Andre, Elena, and Nancy, which is how to use financial innovation in a more effective way by adopting strategic, cooperative, but also more proactive approaches to innovation, so that these can be used then to improve the use of existing capital and to bring in or free up capital for other uses. So we looked at those recommendations in three categories. The first one is freeing up the balance sheet of the MDBs, either through risk transfers to the private sector, with some examples of MDBs that have done this already. I mention often the Houphouët-Boigny Bridge in Abidjan, which the African Development Bank funded and then farmed off to the private sector, releasing that very precious private equity to be deployed in other areas. Then we have donor guarantees. These have been used in different situations, with the UK and Canada coming up, for example, to support bridge financing during capital increases by the MDBs, or coming up with specific guarantees during the COVID period. And then the MIGA MDB relationship and partnerships, which is also very critical, with an example where the World Bank, IDA, and MIGA came together, for example, to put an $800 million facility for the Eastern and Central Africa Trade Development Bank, Eastern and Southern Africa Trade and Development Bank. And that allowed private banks to come and capitalize TDB. And that would never have happened if MIGA and IDA had not come in the way that they did. So all that is to free up the balance sheet of the MDBs and allow them to do more. The second block on innovation was around new forms of capital, hybrid capital being one of the key ones. I know the other colleagues on the panel, like Alexia and Ajay, may talk about that, but also EBRD and EIB have some examples of how that has been done. Recently, the board of the African Development Bank approved a framework for hybrid capital, so we know that that recommendation is already being tested. And then the third block is around the very important role of the MDBs, which is in their countercyclical capacity, and so how to boost the countercyclical capacity of the MDBs. And there it's around solutions for pooling commitments of callable capital by different subgroups of shareholders, particularly for crisis response. The fourth category of our recommendations was really looking at what drives the risk allocation for MDBs and how that then impacts the capacity of the MDBs to lend on the one hand, but also the cost of capital that they can obtain when they go to the markets. And that has to do with the credit rating agencies. And our recommendation there was to enhance dialogue between the MDBs with the credit rating agencies, but also to have strong signaling by the shareholders of the kind of reforms, precisely the roadmaps that we are talking about here, that will show the credit rating agencies that the shareholders are directing and are caring about what the MDBs do, and therefore would not be penalized by the credit rating agencies for the innovations that they may take. And it's also because we realize that credit rating agencies actually have a gap in information or an information asymmetry in terms of what they know about MDBs, because they're not their largest clients. The commercial banks are far larger as clients of the CRAs than the MDBs. And therefore, any additional information and clarity that comes through dialogue would be important. And then the last block of recommendations was around data governance, transparency, and knowledge sharing amongst the MDBs. We found that there's a very limited understanding of the MDBs, so we conducted a benchmarking exercise, which also clarified the vocabulary that is being used about MDBs, and also offered a handbook, particularly for shareholders to better understand the MDBs. Secondly, we saw that the data that the MDBs have is not that known outside, and for good reasons, it is private. But we thought that some statistics and some general information could be shared publicly and therefore be used to enhance what the credit rating agencies know, what the markets know about MDBs, and therefore provide more comfort in the risk knowledge about the MDBs. Just a simple study we did, for instance, showed that if you compare a bond issue by the MDBs in the same geography to a comparative bond by a commercial entity, the MDBs are 14 times less risky in that space. And therefore, that knowledge is not known out there. And it gives an opportunity then for when the bond issues come for investors to come in with comfort when the MDBs are participating in the market. And then finally, the MDBs have done a lot of innovation, but it's trapped within the knowledge base of the MDBs themselves. And we thought that by sharing more information and having a platform where these MDBs can engage with each other, it will shorten the speed from innovation to implementation and lower the cost of innovation for all of the MDBs. So these are the categories of recommendation. And maybe just to say in conclusion that we are quite pleased with the opinions that the credit rating agencies issued when our report came out. S&P and Moody's basically arguing that they didn't see any reason why implementation of our recommendations would result in a downgrade of the MDBs, which was one of the things we're looking at. The AAA in particular is one of the key features to preserve. And Fitch, which issued a caution, also was saying it really depends on how the MDBs implement the recommendations. And then finally, the support that has come from the shareholders who have continued to push for implementation of the recommendations and engage in dialogue as we are seeing here today with the United States, India, and the European Union. Thank you very much for this opportunity. I look forward to addressing any questions that may come up. Thank you.
Thanks so much, Franny. And as you can see from Franny's description, this is really a comprehensive set of reforms that are really mutually reinforcing. And we are, as a panel, quite encouraged by the reaction of shareholders and others to this report, and the interest in really moving forward deliberately and with some speed on the recommendations together. So this has really been very encouraging. I just wanted to encourage the audience, if you're interested in posing some questions, to find the Slido page on the Bruegel website and enter your questions using the code development, and we will preserve some time to have some interaction with the panelists. So let me turn now to the panelists, and first to Soha to dive into these recommendations that Franny described as they are viewed from the standpoint of the institutions themselves. Soha, you're very well placed to assess the benefits of the report's recommendations with respect to risk transfers to private insurers and to investors, which frees up capital for more lending. The African Development Bank, one of the other MDBs, the regional MDBs, has launched 2 such transactions, one for sovereign portfolios and one for non-sovereign. So we'd be interested in hearing from you about the relevance of these sorts of transactions in your region, any plans that the EBRD has to move forward on these kinds of transactions.
Sure. Thank you, Nancy. And just before I start, good morning, good afternoon, and good evening to everyone. And I'd like to thank the organizers for this invitation. It's really an important discussion to take part of, especially from the perspective of the EBRD. Now, this specific point is quite interesting, actually, given our private sector focus. Of course, the transaction that the AFDB had done was quite innovative, and it attracted a lot of attention. And we, in particular, examined the dynamics of that transaction very carefully, also to check the opportunities at the time, and we continue to do so. Such transactions obviously are very important for optimizing capital, but they're also very important from our point of view for mobilizing private investors and introducing them to our markets. Now, this specific recommendation is actually very much aligned to EBRD's strategy, because one of our core strategic objectives is the mobilization of private capital, where we have a very active risk transfer mobilization program, using both funded and unfunded risk transfer tools. As a matter of fact, I think next to the IFC, we're the largest active regional bank in this field. So in terms of risk transfers, again, whether through funded or unfunded tools, we've done around 3.5 billion of mobilization over the last couple of years. If I focus specifically on unfunded risk transfers, which is the same concept of the synthetic securitization that AFDB had done, we have a very active unfunded risk participation program. We engage with currently around 14 insurers, which are growing, and we have signed around 1.3 billion of unfunded risk participations in 2021 and 2022. So we're actually quite active in risk transfers. Our primary motive has always been to mobilize private sector investors, rather than to optimize capital, because we were not capital constrained. However, it of course has the added value and also primary value now, given the discussions that we're having, of optimizing and allowing us to expand our capital capacity. The interesting point to raise on our focus on URPs is that they are also unblended. So we do it without necessarily requiring any donor support. Now, for the EBRD specifically, and we also need to be careful with or be clear on the nuances or the differences between the organizations and how these tools fit different organizations in different ways. In our specific situation, our business model makes it a lot better for us to focus on transaction-based risk transfers versus portfolio-based. And that's what we do with our unfunded risk participation program, because that allows us to introduce the clients to our investors. It allows us to target a lot better, the areas where we want to optimize, whether on client or country basis. And it also ensures that the types of investors that we bring in are actually interested in operating going forward in our countries. Now, one important point when we talk about risk transfers, capital optimization, and the CAF is that we need to understand that it has different impacts on capital capacity on different organizations. For example, for the EBRD in particular, something like a risk transfer, while it reduces the riskiness of our exposures and gives us risk-taking capacity, does not actually reduce the size of the balance sheet. So it does not help us with our leverage ratios. Now, obviously, both leverage ratios and capital-based ratios are important. So it helps creating space on the capital-based ratios, but it does not help us with the nominal ratios. Having said that, some organizations are more, or some MDBs are more constrained on one rather than the other. I believe the AFDB at the time of this transaction was focused more on optimizing its RAC ratio with S&P, where it had no, I do not believe they had the same level of constraint on their equity to asset ratios, etc. This is not to say that it does not have a place in the capital optimization framework. Of course they do. It's just that we need, in approaching the products we select to achieve this objective, we need to be careful with the pricing and the profits that we give up in association with the tools that we use. Now, we are all aware like something like this, synthetic securitization could be pricey, could be time-consuming, etc. So we always need to balance the benefit that we get, the capacity that we create versus the cost, because it also, the cost and reduced revenues does impact our ongoing profit accumulation ability. So in conclusion, it is a very powerful tool. We're using it, we will continue to use it, and we continue also to look at other alternatives, including synthetic securitization at the right time for the right reasons.
Thanks, Soha. And I think your comments sort of illustrate the utility and importance of knowledge and experience exchanges across the institutions to start to bring down these transaction costs so that the first movers can help later adopters do these transactions more efficiently. And now let me turn to Andre. EIB has a special role in leading the management of what's called the GEMS database, the Global Emerging Markets Database, which is this hugely valuable set of data across more than, I think, 20 institutions over many years on the credit performance of MDBs, both for sovereign lending and non-sovereign lending. And as the panel found, that database is extremely valuable. It helps quantify the value of preferred creditor status. It helps if private investors had more access, it would help them assess the creditworthiness of transactions, SDG transactions in the developing world. And it certainly would be helpful to credit rating agencies who have to risk weight MDB portfolios in order to produce their ratings. So this is a very important effort that EIB is leading to turn the GEMS database into a standalone corporation with a mandate to produce harmonized statistics and regular reports. So we would appreciate an update on that effort and your assessment of what the best way to go about doing that is, and the notional timing for moving forward with that objective. Andre.
Thank you, Nancy, and also many thanks to the organizers from Bruegel for inviting me to this panel. It's a privilege to sit alongside so many distinguished speakers. And good afternoon, morning, or evening to everyone. GEMS, as you know, is very close to our hearts at the EIB. The GEMS consortium, which was established in 2009 by IFC and the EIB, has been pooling credit data from MDBs and other development institutions, and it's been providing this data to its members. Today, GEMS counts 24 members from the MDB and DFI community. And indeed, GEMS holds a vast database of credit events on projects, notably in emerging markets and developing economies. And for lower income countries, GEMS probably contains the most exhaustive set of credit data, both in terms of data point coverage and the length of coverage, as you mentioned, Nancy. So clearly, this data set has attracted a lot of interest from external stakeholders, institutional investors, asset managers, rating agencies, and commercial banks, which GEMS in its current setup tried to address with the first default statistics report that was published in 2021. The CAF review clearly recognized the benefit and the potential value of this data set, as well as the need to evolve the GEMS structure and make that data better accessible and usable. And we likewise in the consortium recognize that need, and we are working, in fact, towards what we are calling the GEMS 2.0, which should be a setup that will ensure broad access to the GEMS statistics while ensuring appropriate protection of data quality, appropriate governance, and sufficient funding and resourcing. the GEMS steering committee has regular discussions about paving the way for this transformation into a standalone entity. Now, the first step in this path is in fact to identify or define the optimum operating model for GEMS, for the new entity. We do believe that the GEMS statistics should be made available to all the stakeholders as a global public good. So ideally freely accessible through an online platform. As you said, the statistics could support analyses, better inform investment decisions, and help catalyze development of innovative data products for market participants. Similarly, publicly available data could also help improve the understanding of the risks that MDBs have on their balance sheets and how these risks are perceived by market participants. This could in turn help, as Soha just mentioned, the mobilization of private sector investments, both for further supporting of the lending objectives of MDBs, the SDGs, climate targets, and similar. And of course, also for the MDB community, GEMS could promote comparable risk approaches across MDBs and the development of global standards and risk practices. So we do foresee that GEMS would be operating under this public good model. So it would be non-commercial in nature, but it would of course closely cooperate with third parties, public agencies, institutions, private investors, academia, to ensure that its data offering is relevant and useful for the stakeholders. But as you can imagine, sharing GEMS statistics as a public good requires very strong processes for compliance, governance, risk management, and of course, data management and data security. We also need legal safeguards, and last but not least, appropriate funding and resourcing to ensure that the entity is self-sustainable. So the GEMS steering committee is now formulating the key principles that will underpin what this new entity is about and is like, and how to ensure that the public demand is met while the confidentiality of the data is protected, so that the MDBs continue to entrust it to this new GEMS entity. I hope I have managed to outline the complexity of the legal and operational implications. Of course, it is also time consuming. So as I say, maybe in where we stand now in the process, we are now assessing the understanding and the scope of the limitations of the GEMS data set itself, and trying to understand the market demand and the potential uses of this data by the market participants. Market surveys are envisaged to be launched to this effect and to be run this year, and their outcome will inform what data products this new GEMS could develop, and what the operating or the business model of the new GEMS entity should in fact be like. So the GEMS steering committee should be able to explore or provide a blueprint for the GEMS 2.0 incorporated entity, hopefully on the basis of these market surveys. As for the time frame, there are a lot of steps to be undertaken. The current planning does not foresee the new entity to be up and running before the end of 2024. But of course, we are pushing to shorten that timeline as much as possible, as we ourselves are fully supportive of this GEMS transformation, and it has been in the planning for a while now. So I hope that answers the question. Thank you.
Thank you. That was really helpful, Andre, to give us a sense of the steps needed to produce this. And we can certainly, from the panel perspective, assure you that there is a lot of interest in this data, including by the credit rating agencies themselves, and a great willingness to incorporate the data into their methodology to strengthen the accuracy of their risk weighting, which would have, as we've discussed, an enormous impact, we think, on the capital usage of the MDBs. So now turning to our critical shareholders, Alexia, the Treasury Department has really taken a very clear position that the MDB should carefully consider all of the recommendations and move forward with implementation based on board decisions of how the recommendations apply in each institution's particular circumstances. So you're in a position looking at across all of the MDBs and developing US positions in the boards to have a sense of across the institutions where you see the most progress and where you see MDBs as leading progress. And also whether you're seeing any sort of collaboration across the institutions in consideration of the reform. So what's your perspective on what's happening, what's moving forward with significant progress, and where maybe what we can expect to see this year?
Great, thank you so much for that question, Nancy. And I also want to thank Bruegel and the Center for Global Development and the European Commission for bringing us together on this really important topic. I think I want to start by saying it's been pretty phenomenal to watch a report jump out and off of a shelf into G20 conversations, into boardrooms, technical workshops, retreats, stakeholder engagements, think tank engagements. So I think my first message is definitely, and I think you were right to highlight Franny's leadership and all of the members of the CAF report, really, I think, delivered a product that is sparking reflection, that is sparking innovation, and that is sparking doing things differently. So this is a live report, not one sitting on a shelf. And it is one that the Treasury Department takes quite seriously. We ourselves have had to sort of digest it and really think through the short-term wins, the long-term wins, but also understand the implications of choices, because there are implications of all choices in the recommendations, including, for example, on some of the innovative recommendations that Franny highlighted. For example, the use of more guarantees from shareholders of the sovereign portfolios of the MDBs. And so, frankly, Treasury for the first time is putting in our fiscal year budget, guarantees to MDBs. That's great. It has a cost. It's actually quite cost effective, but it has a cost. Or if we talk about hybrid capital, which of course we've been discussing quite a bit, the cost to borrowers will increase. So you get more volume, but at a slightly higher cost. All of that is fine as long as we're thinking holistically about how the recommendations interplay with each other and what the implications for donors and borrowers are. So my sense is that all the MDBs that I follow the most closely are taking this report very seriously. And we've heard from two of them today, one of which EBRD, the US, is a member of. Obviously, I think the World Bank got a very specific ask by their governors at the Development Committee to really move on the CAF report. So I think in some ways there's been a stronger, more formal ask to the bank and to move. And so we've seen a lot of work there in particular with a phased approach where the bank has been asked by a number of its shareholders, including the United States, to come back at the spring meetings, which is just next month, with movement in certain areas, specifically with respect to the equity to loan ratio, which we've discussed. And there is a firm proposal, on the table from the World Bank that could free up at an annual level about 20% additional capital annually for the bank. So that's great. The other thing that we expect by next month from the World Bank is for them to set the conditions to be able to issue hybrid capital. So we talked about African Development Bank having moved last year. We're looking for the World Bank to put in place the framework to be able to issue hybrid capital. And then the third key area for next month for the World Bank is linked to removing the adjusting the statutory lending limit in its charter. So these are three very concrete recommendations, very short term. This being said, there's going to be a lot more work that we expect to see from the World Bank, and it has, I think, taken this quite seriously, where over the medium term, we want the World Bank, and here I would say, all of the MDBs to also continue to think through how they can revise their capital adequacy frameworks in a way that suggests they can take more risks. So that's recommendation one. And this includes looking at how to give more weight to the preferred creditor status. For those regional development banks, how to give less weight to concentration risk, something that the CAF report also highlighted. And then some risk reduction credit based on the capital, callable capital that Freddie also mentioned. I think what's important to say, though, is that these three steps, on the MDB side, has to be in parallel to the rating agencies themselves also evolving, right? And so my understanding, Franny, you'll correct me if I'm wrong, is that the recommendations 1 and 2 very much are predicated on both MDB action and on credit rating agency action. And the two together can create some of the very significant boosts suggested by the report. But you need both to get some of the broader, longer term boosts. So I think it's really important to make that point. So the World Bank, again, has an official process, a roadmap that has been published with both short-term and longer-term work coming into play. And the idea is that by the October annual meetings of the World Bank, we really will have seen the full package of what they're doing with respect to the CAF report. I do feel like it's really important to also say, if I may, Nancy, and Elena made this point, this is fundamentally about development impact. This exercise is about the MDBs continuing to be super relevant for countries facing multiple crises and impact. And so we cannot forget that as we talk about the CAF report. And in the US's perspective, boosting financial capacity is one critical piece of a broader agenda to evolve the MDBs to be able to face some of the transboundary challenges that Andre mentioned. He mentioned pandemics, he mentioned climate change. I would add fragility and conflict that actually threaten or are already undermining progress on poverty reduction and on achieving the Sustainable Development Bank's goals. So we also need to be looking at the vision of the banks to make sure they're sort of updated to really be responsive to the new realities and challenges of our world. We need to be looking at the operational models of the development banks as well. And we need to be looking at the incentives of the development banks as well, in addition to, of course, boosting financial capacity. I think you've said this, Nancy, but I also want to underscore that as beyond the World Bank, the other development banks are also making progress. I was, say that this is not new, and Elena said this, right? So we've seen really great innovations for a long time from some of the regional development banks, the African Development Bank. Soha mentioned the room to run sovereign transaction. I think from the Asian Development Bank, we're really pleased with the work they're doing on the innovative financing facility for climate in Asia and Pacific, where the ADB will look to pool donor guarantees that I mentioned already to guarantee a slice of the ADB's sovereign portfolio to free up headroom for more climate lending. So that's quite exciting. And so there are discussions happening at the board of all these institutions. And I think we as shareholders are quite bullish on the institutions stretching their balance sheets responsibly, because I do need to also say that we need the MDBs to act up and scale up with urgency now, but remember that we count on them to have a counter-cyclical role as well. And we saw that actually on full display, right? When COVID hit, the economic consequences of Russia's brutal invasion of Ukraine, one of the first institutions a shareholder like the United States looks to are the MDBs. And they have to be able to sort of scale up their financing literally overnight in these times of crisis. So that counter-cyclical role is also very important. Perhaps the last thing I'll say, and happy to engage in more questions, is, yes, the scale of the challenge is so huge. Nancy, you talked about the Nick Stern-Songway report, and the MDBs have done a lot, can and must do more with quality, and they will not be the only solution. So financing for development was right. Addis Ababa Action Agenda was right. We need domestic resource mobilization. We need the private sector to come in. And I think that's a really important cross-cutting theme of the CAF report that's implicit. And I think we're working on making it explicit. The mobilization of private sector capital, the risk sharing piece is really critical. IDB has its annual meetings later this week. And the vision for IDB Invest 2.0 is very much a risk-sharing model with the private sector in a pretty aggressive way. We're really supportive of that. But you'll also need, pure public money for certain interventions in the space. So private, public money, and domestic resources, all of this is needed to actually step up to the challenges that countries face today.
Thanks so much, Alexia. And those are some really powerful points, both about the need for all hands on deck and the implication that just because any one of those pillars of effort is not sufficient, it doesn't mean that that those actors in the system can step back at this point. All have to really step forward together. And it is really a test of the MDBs. They are tested at this point to determine whether they can play the role that the world is asking them to play. And of course, we know that there are some proposals to create new institutions for those that are not seeing what they want to see from the MDBs. So and so this is really an opportunity for the MDBs to show that they can really respond to it across the board. And your other point about that this is not just about technical finance issues, it's about impact, is critical for us to remember. And I'm going to turn back to Franny in a moment after Ajay speaks on this question of the role of the credit rating agencies, as Alexia pointed out, because this is not just action on the part of the MDBs, but on these critical actors, to the credit rating agencies in terms of their response. But Ajay, India is playing a central role in all of this with the presidency of the G20. The G20 has been a really important driver, the source of the mandate to do this report and a driver of consideration of the report. And the G20 chair summary called upon the IFA working group, the International Financial Architecture Working Group of the G20, to develop a roadmap. So we're really at a critical point, but it would really be helpful to know from your side what you see as the role of the G20 in advancing this agenda as distinct from the role of the boards themselves.
Thank you, Nancy. And we are having a very intense and fruitful discussion. And the G20, this independent panel, is a product of G20, and Franny referred to that it came into being during the Italian presidency. And she also mentioned that it has survived 3 presidencies. Let me share, is a lot more than that. And it has not just survived, it is gaining very strong momentum. And in the Bangalore meeting of finance ministers and central bank governors, there was very strong keenness as well as very unequivocal support to make these recommendations reach their logical conclusion and get implemented in their letter and spirit. There was a very wide support, not wide support, almost everybody. Not almost, everybody supported that this must happen. Of course, these decisions on these recommendations have to be taken by individual MDBs. And each of the MDBs have their own circumstances, their mandate, their governance structure. So that said, the role which G20 can play as a platform, as a forum, is to help that momentum continue and that consistent effort. And our effort here from India during this year of presidency is that how we can help all the shareholders in various MDBs and especially those who are present in the G20 forum to make concrete progress on these recommendations. And let me share with you that what I've been hearing from my colleagues who are present in the International Financial Architecture Working Group. Some of the MDBs have made very solid progress, and we heard Alexia talking about what is happening on the World Bank side. In the IFA working group, I understand that they have suggested a common template, and they are meeting later part of this month. towards the end of this month, where all MDBs have been requested that in that common template to share information that what progress they have made, what have been their views of their board's views, so that then update is available in a harmonized manner. And when we present it to the ministers and the governors, that a common thread can be evolved and can be seen from there. At the same time, not just the reporting aspect, but IFA working group is also trying to provide a platform so that some of the difficult part of the recommendations can be intense discussion. At least the shareholders which are present on this platform, the G20 platform, can reach a common understanding. And some of them we have noted in today's interaction as well about the callable capital, about the preferred creditor treatment, that how do we take that forward and how do we engage credit rating agencies in that aspect. And of course, in collaboration with France and South Korea, which are the two co-chairs of that working group, Indian presidency is working that how do we help that process and get the common thread in from the MDBs, how they're engaging with credit rating agencies, so that the potential impact, there are no adverse impact. In fact, that can be the existing MDB ratings can be nurtured. And then we propose that how do we report back? So for that aspect, we're also aiming at and to organize a dedicated interaction of MDBs with the deputies before we report to the ministers. Ministers are expecting that by the third meeting in July, they would expect a roadmap, but we still have a lot of grounds to cover. So beyond IFA interaction in later part of this month, early by the sidelines of the spring meeting, we are organizing a interaction between MDBs and the deputies so that there's a better understanding. And if there is any common grounds to be message to be taken to our ministers, governors, we can work together. So I'll stop it here and come back as the conversation flows further. Thank you, Nancy.
Thanks so much, Ajay. That's, excuse me, a very helpful clarification of how you're seeing how India is seeing the process and how India is seeing progress so far. I have a few more questions for our panelists, and then we're going to go to audience question, but I wanted to give Franny an opportunity to respond to Alexia's point with respect to the role of the credit rating agencies in all of this, how they've reacted, and how engagement with them going forward should work.
Thank you very much, Nancy, and I appreciate a lot the remarks that have been made by Alexia and Ajay, but also by Soha and Andre on the implementation by the MDBs. On Alexia's question, during the preparation of this report, we did a very wide consultation of the different stakeholders, and one stakeholder group with whom we engaged very intensely were the credit rating agencies. So the three major ones, S&P, Moody's, and Fitch. And they reviewed our report. They provided their comments. Of course, they are independent, but they could opine on what we were saying. And when the report came out, they issued opinions, which are public, and they can be seen since they're available to the public. And one of the things that struck us is how engaged they were, particularly on the preferred creditor terms and on callable capital. They also wanted to have a better understanding of how that can feature into their methodologies. There were three key issues that came up. The first one was access to data, because for them to incorporate, for example, the benefit or uplift from preferred creditor terms, they needed to know the incidences of default. And those are privately held pieces of information. But with the work that we were able to do, we could aggregate publicly available information, and at least for the sovereign part of the work, to show that hardly any MDB had seen a default by sovereign. And therefore, the probability of default is so low that that credit or uplift by the CRAs really has to be substantial in order to give full credit to PCT. And now they're engaging in dialogue with the MDBs in order to get a better handle of that for the non-sovereign portfolio, where there are some cases of default. But even then, we were quite surprised to see the benefit that non-sovereign loans have with the halo effect that comes from the PCT on the sovereign side. The other area where we engaged quite intensely was on the callable capital issue, also for them to better understand how that features. And also it gave an opportunity for the CRAs themselves to share information on how some of them are already giving partial credit for callable capital. In fact, we had a very interesting event hosted by Center for Global Development, where the CRAs were on the panel along with private banks and, of course, ourselves. And that gave an opportunity then to engage more deeply in terms of the difference between how CRAs rate the commercial banks, for which they have access to a lot of information because of the regulation of commercial banks, versus the MDBs, which are self-regulated entities and therefore highly dependent on the availability of data. And why, therefore, what Andrej said on the GEM side is so critical, because that was the third piece, which is access to data. The CRAs were very keen to see whether they can have access to that data so they can improve their methodologies, and also they appreciated very much the benchmarking of MDBs, because the MDBs are quite different, but they have a lot of similarities. And by the panel pulling together the similarities and definitions has given a lot of information to the CRAs that they didn't have before, that allows them to do a much more effective benchmarking across all MDBs. So we hope that that dialogue continues, and that's why we are also recommending for this forum, the MDB forum, where they can come together and engage with the CRAs and the shareholders in an open learning space that allows information to flow. And then the last thing I will say is that our report is unique in a certain way as well. And thank you, Ajay, for the run through of the way the report has been received by the shareholders. We have the philanthropists who have come together and put together a fund, the MDB Challenge Fund, where they have called for competitive proposals to see how these recommendations could be implemented, if there is a need for innovation and piloting, a need for further study, for example, on callable capital and PCT, or a need for MDBs to test one or two innovations that they are already working with that need a little bit of funding to get them over the fence. And the results of the competitive process will be announced during the spring meetings. And we think that's going to give another boost to these recommendations, because I think it will be quite exciting to see what has come through the competitive process. And some of those relate also to the CRAs and the MDBs and how they work together. Thank you.
Thanks, Franny. Yes, we definitely look forward to seeing what comes out of that challenge fund as a kind of critical support set of tools to support implementation from inside and outside the system. Sohad, I wanted to turn back to you on this this question of callable capital, which the audience may not understand really represents the bulk of capital subscriptions for many institutions. Callable capital much larger than actual paid-in subscriptions. So it would be helpful to understand from you how EBRD sees this question of how to give value to callable capital, and what kind of analysis is the EBRD contemplating in order to make decisions with respect to valuing capital in EBRD's capital adequacy framework?
Sure. Like you said, I mean, callable capital is kind of a unique form of capital for MDBs. And it is usually not there to be called upon on, under normal circumstances. However, it is a very big part of our capital structures, and it is given weight by rating agencies. The report does say that it encourages us to incorporate callable capital to the degree that rating agencies do. Actually, at the EBRD, we have our own internal capital adequacy policy. And we already include callable capital in that policy to the extent that it is used by rating agencies. And let me explain how we do that. I do recognize that the report, Franny, did not point to that specifically, but we've actually already for years have had this incorporation. So for example, S&P provides an uplift in our rating if capitalization levels fall below a certain level. If you have callable capital from highly rated shareholders, they kind of give you an uplift, even if your capitalization ratios are not at the best levels as identified by S&P. So in deciding how we design our internal capital adequacy policy, we do exactly that. Now we do without going into the details of how the policy is actually designed, because it is rather complex, we do calibrate it such that we allow capitalization ratios, acceptable capitalization ratios, to go to a level that would keep us at a triple A rating after an uplift. So that has been the case for quite some time in our case. And we continue to operate under this policy, and we continue to set our prudential limits accordingly. Now, obviously, there are always trade-offs between, while every organization or every MDB will have its own internal policy, some MDBs incorporate multiple rating agency metrics. Some of them do, have their own more internal bespoke ones, etc. But at the end of the day, all of us look at the different ratios, at least for planning, in order to ensure that we're on the right track in terms of our ratings, etc. So our internal policy does incorporate callable capital into it. However, we always have to keep an eye on leverage ratios, etc., to make sure that we do not obviously do any significant breaches there. So this would be, this is one recommendation that is could be applied, and I think at least 2 banks do it. So it is something that is worth considering by others. It has so far worked for us very well. So.
Thanks, Soha. And I wanted to turn now on the risk transfer recommendations to Andre to get a sense of how EIB is thinking about this. The basic idea here is to take performing assets and to transfer the risk to free up capital for additional lending, which can be a very scalable way to increase the available capital in an institution. It relates to what people have described as shifting the MDB model to a kind of originate to distribute model rather than an originate and hold model. So if MDB comparative advantage is to originate high quality SDG investments, then perhaps it makes a lot of sense for MDBs to originate these projects and then offload the risk when the project starts to perform. So how does EIB think about this? Is EIB considering doing some transactions at the portfolio level in order to scale this sort of operation? And what are the sort of pros and cons as EIB considers it?
Thank you, Nancy. You're probably aware that we, the EIB, are one of the largest users of risk-sharing tools, in particular with the public sector, with the European Union, represented by the European Commission, Elena here, or with our member states, so with the shareholders. Just to list a few.
Andrea, I think your screen is frozen. If you can hear us, let's see. I think he's reconnecting. Let's give him
apologies. Sorry. Can you hear me? Apologies, I just got a message saying I was disconnected. Indeed, I hope I wasn't interrupted too soon. So these are risk sharing, risk transfer structures whereby we originate operations using our expertise, and some of the risk is transferred to willing counterparties, freeing up our capital headroom to originate more. The CUF report, and I think also some of the rating agencies have recognized EIB's leading role in this synthetic risk transfer. Now, what we have found through our experience is that it is easier to implement risk sharing structures with the public sector, given the alignment of objectives, given the acceptance of MDB specifics, as well as what Soha mentioned earlier, the cost perspective, or P&L perspective. Such public sector risk transfer still provides leverage on public funds that is probably greater than what we could achieve in a mixed public-private risk transfer structure. And of course, they still allow the crowding in of private sector investors at the level of each underlying transaction. To say, I think risk transfer, if structured properly, is indeed a powerful tool for increasing the risk-bearing capacity of MDBs. MDBs have very high rating targets, which as one core pillar depend on strong capitalization levels. So risk transfer can reduce the the capital intensity of MDBs portfolios, and so enhance their capacity to deliver, in particular, volumes of higher risk operations without putting their ratings at risk, or indeed without requiring capital increases. So these techniques are in particular suitable for higher risk portfolios, as we've seen in the past, also probably some of our peers. And they, of course, they allow, as I said, they allow us to use our existing expertise, local presence, and tap into the risk-bearing capacity of third parties, investors who would normally not be able to reach the same borrowers as we are able to. So, and of course, risk transfer to private sector could open a new investment opportunity for private sector investors who could be interested in diversifying their existing portfolios with this new asset class. So that would obviously bring new funding opportunities to the MDB toolkit and to the developing goals. And of course, GEMS, as I mentioned before, is clearly critical in this context. And last but not least, I think one of the benefits of risk transfer is that it is already today widely recognized by both the markets, but also by the rating agencies. And here I have to say we've had a very fruitful discussion in the past in the context of the investment plan for Europe with the rating agencies, how to get recognition for such synthetic risk transfer in their rating agency frameworks. Now, Nancy, you mentioned historically MDBs have operated an originate to hold business model, which was of course dependent on sufficient shareholder capital being available, but it also allowed MDB loans to have specific, not necessarily market terms. Now, if we were to shift to an originate to transfer model, it would, of course, first of all, mean a mindset shift for MDBs, but of course, that is exactly what is required of us at this stage. But of course, it would also require an education or a change in the mindset from the borrowers and the investors. A larger expansion of such model would force MDBs, or could force MDBs, to adopt more of a commercial bank-like approach to the loan terms, make them more understandable and attractive to private investors. And we would of course also need to ensure that the economics of such risk transfer transactions would continue or would work, that the cost of risk transfer would not affect the financial value added or the funding benefit that we pass on to our borrowers, and that this wouldn't impact our own self-capital generation ability, which also Soha mentioned earlier is very important for increasing our own lending capacity and making ourselves self-sustainable. Said differently, we would need to make sure that such private risk transfer is sustainable, is designed sustainably. And of course, we would need to assess whether this could have an impact on our ratings. I think in particular, talking about risk transfer of sovereign portfolios could theoretically be seen as impacting on the value of PCS if there is dilution. And last but not least, also Soha mentioned lending capacity of MDBs is frequently not constrained by the risk-adjusted capital adequacy, but rather by nominal metrics. Typically, and the CAF review recognize this, these are the statutory loan to equity or leverage or gearing limits that are imposed on us. Which at times constrain the growth of our portfolios, and of course they are not helped by synthetic risk transfer. True sale transactions could help alleviate that constraint because they would shift loans from our balance sheets, but they may require our assets, first of all, to be transferable, again, which would change the lender of record, which is not always an easy step to explain to our borrowers, and it would bring back the need to have more commercial bank-like terms on our loans. So this is also a constraint. Now, just to summarize, so we certainly see potential in further developing risk transfer structures. In the EIB, it has been a part of our toolkit for years, and we have used it extremely successfully to, in particular, build higher risk portfolios. So it's very useful for increasing our capacity for higher risk operations. But of course, there are considerations or constraints on this being infinitely scalable. And of course, the question also is whether we find suitable projects to build portfolios on which we find interested investors to efficiently transfer the risk to. Thank you.
Thanks, Andre. That's a very helpful review of the challenges, and I would just note that Alexia very firmly put on the table this question of statutory limits, which shows on the shareholder side that there's a clear understanding of their importance, and also that on this question of PCT and lender of record, that the African Development Bank developed this innovative way to transfer the risk without transferring the lender of record. So it still holds these assets on its balance sheets. It's transferring the risk, which maintains the integrity of preferred creditor status. So it's another example, I think, of the usefulness of sort of learning across the MDBs as we move forward. Alexia, I wanted to turn back to you on one other aspect of the recommendations, which has to do with hybrid capital, which is another potentially fruitful way to increase the available capital and therefore allow that capital to be leveraged with more lending. So this is an idea of issuing assets that don't confer governance rights, but add to available capital in ways that the credit rating agencies would give value to in terms of equity. So from the shareholder perspective, how do you see this notion of issuing hybrid capital? Do you see it as scalable, and do you see it as something relevant across the institutions?
Thanks, Nancy. I think we all panicked when we thought we had lost our moderator. So good to see you. Good to see you back. And I think the U.S. we're tremendous fans of the potential of hybrid capital, to be frank. So we see a lot of opportunities there, and I think you've already said quite a bit about it. So, for example, when we're looking at hybrid capital issued to the private sector, we see that the rating agencies will count a substantial portion of it as equity that can be leveraged. So I think up to 75%. So that's great. We don't see governance issues, frankly. I think there are issues of, what's the responsible private sector that we care about, but beyond that, we don't see governance issues with issuance of the private sector. And as I mentioned earlier, there would be a resulting increase in the cost of the debt. But we do think it would be manageable, as the sort of the increased cost of subordinated debt would be manageable because it would account for such a relatively small percentage of overall debt, right? And I think another important point about hybrid capital, which is very attractive to us and sometimes gets overlooked, is its potential to be used as kind of a risk management tool in the sense that if there's a shock that causes an MDB's capital ratio to breach an important threshold, then hybrid can actually be issued quite quickly to the private sector to help bring back the ratio to a safe level. So that's quite attractive to us. Now the issues are, and the dynamic changes a little bit if you're talking about issuance to shareholders. So for example, the governance issues might be more pronounced if you're issuing to shareholders, although again, I think it would actually be limited in the sense that rating agencies limit the hybrid they count as equity to 30% of total equity. So I think there'd be sort of a de facto cap on it, right? And perhaps the cost issues that I mentioned might be lower when you're issuing to shareholders because the shareholders will demand lower coupon payments than private sector actors. I think in the discussions that I've had with other shareholders on hybrid capital, I think the main limitation I see so far is the issue of cost. And we hear from some borrowing shareholders that they actually are quite sensitive to any increase in loan pricing, no matter the size of that increase. And I think it's important for everyone to understand that any increase in the size would apply to all the outstanding loans of the borrower. This said, I do think the pricing issues may be less pronounced in the case of private sector focused institutions, like of course EBRD here and the IFC. And I did want to note that I think you touched on this, Nancy, that the African Development Bank has been doing really interesting work that we really appreciate in terms of potentially channeling special drawing rights to MDBs in the form of hybrid capital purchases, which I think is quite interesting. Nancy, if I may, because I know that we're coming close to time, I just wanted to add 3 quick points. One is a word that Andre used, mindset. I think a lot of what we're talking about is very technical, but actually if we're really going to deliver on it, it does require a mindset change, both from shareholders and from the MDB management as well. And that will be really critical in terms of what we're asking these institutions to do in today's world. The second point I want to make is we've talked about differentiating across MDBs, but there's a need for nuance throughout this exercise, including differentiating between the private sector side and the public sector side of institution. I think Andre was pretty clear about that as well right now. So for example, we see in the shorter term, a lot more opportunity on risk sharing on the private side than we do on the public side, not to say it's impossible on the public side. And the last thing I want to say is I think the US position might be sort of summarized by actionable ambition. We have to be ambitious, and we need to deliver, not just talk about big, exciting concepts. And I think for that, it means that the political will, the G20 work that Ajay, you're leading and India's leading is so critical, but the devil's in the details. So for example, I really believe in the power of risk sharing, but we also need to understand that part of what it takes for a country to develop is public sector as well, right? So we're very bullish on private sector mobilization, but the public sector has a role. The US learned this with COVID, right? And so I think we need to push really hard where we can get the private sector in, which markets, what sectors, but not rushing over where we still need a strong public sector role. So details, nuance, and precision matter in this ambitious agenda.
Thanks, Alexia. That is really introducing a helpful balance to the discussion. It's not all about allowing the private sector to, or giving opportunities to the private sector to do development finance. The public sector has to well, often is on the other side of those transactions and has to play a critical role, particularly in things like infrastructure. So Ajay, I wanted to hear from your side on the voice of the emerging markets in all of this, really a critical voice, both because big emerging markets are big shareholders, but also because big emerging markets are important borrowers for these institutions. So what is India's thinking about this agenda, and what are you hearing from your colleagues in other big emerging markets about this agenda?
Nancy, let me share with you what the conversation or the views I'm hearing or I heard interacting with colleagues from emerging economies, developed economies. Number one, a very warm welcome, and they see that it has got a very strong potential to unlock a significant amount of development financing coming from the MDBs. So there's a welcome. At the same time, there's a bit of a complementary question that is that enough or something more needs to be done? And I'll come to that question in a moment. But specific to CAF agenda and the recommendation, there's a bit of a concern that would enhanced volume of lending, stretching the balance sheet, will come at a cost, which Alexia also referred to it, that will it lead to increase in the cost itself? And then that general response is, do it by all means, but do it in a manner so that the costs don't go up, and they equate it with a AAA rating, and of course getting the preferred creditor status being maintained so that that cost doesn't go up. At the same time, one of the suggestions coming from the emerging economies is that if the MDBs were to engage with credit rating agencies individually, perhaps the result may be suboptimal. And Franny also referred to that, whether she referred to an MDB forum, whether that forum can engage with credit rating agencies. And of course, she mentioned that her group, the panel engaged with them, but now for the MDBs, who are the clients or who have to get themselves rated, not the clients in that sense, whether collectively they should engage, that is also the suggestion coming from emerging economies. Now moving it further, the question which is coming up, that is this sufficient? And so what I'm hearing from emerging economies is that one should take a holistic view. CAF recommendations are one of the very important pieces in this canvas, but other pieces also needs to be addressed. And what Alexia was saying, that we have to be ambitious, at the same time being practical, that we deliver one piece at a time, but don't exclude a critical piece which will make the entire canvas incomplete. And in that context, a holistic view, of course, would be on in terms of the overall MDB strengthening, and what the vision, what the mission has to be, how do we balance the transboundary challenges with the existing challenges around poverty and for the other development issues on sustainable development goals, and of course, on operational model. And ultimately, the emerging economies are very clear. It is about making the impact on the ground, being effective. And there's a full realization. What Alexia said, it is not just the MDB capital coming in. It is also about the domestic financing, the private financing, and how that she mentioned that hybrid capital, and different people have been talking about at the blended capital. And there are different views whether it should be at the project level. And we heard Andre saying it, that whether there are enough projects or good projects where the risk can be transferred. There was another thought came in one of the conversation, whether we can have a mechanism wherein the risk transfer at a higher than the project can be feasible option. And I'll close it with this, that there's a very strong opinion, not a strong opinion, saying that while all this is needed, at the same time, we have to also talk about that whether stretching the capital without talking about increase in the capital itself would suffice, because the needs are very large. And everybody is aware that we have to be careful about the sequencing. Bring everything on table, deal with one piece at a time, but don't exclude ab initio something which is needed. So I'll close it here. And some of this conversation, I'm glad to report, is getting a good conversation around the G20 table. And I'm hopeful that this interaction, like the forum today and the other conversations which are happening, we will be making progress collectively. Over.
Thanks, Ajay. And you picked up a question that we have from the viewing audience, which is this question of AAA ratings. Was the panel asked to assess the need for AAA ratings? And the answer is no, but is what, you address the shareholder view of whether AAA ratings are important, and which is something we've certainly consistently heard, that there's not an appetite at this point for changing those ratings, and everything that the panel recommended was within that constraint. In other words, more capital efficiency, but while maintaining the AAA ratings. So I think we're pretty much at the end of our time. So I wanted to give each of the panelists, and Franny and each of the panelists, an opportunity to say one final word about whatever aspect of this agenda and these challenges you want to discuss. And if you could keep it to a minute, that would be great. So perhaps I could turn to you, Franny, first.
All right, thank you, Nancy, and thank you for this wonderful conversation we've had here. My short summary is that the world is in a situation that relies extremely on the MDBs. Addressing the recommendations in the Capital Adequacy Framework report is an important piece to providing that opportunity for MDBs to do more, because it will prove that capital can be used efficiently, MDBs can react speedily, and that they can attract others to come and join them from the private sector and from the markets to deliver on the important development objectives. And that would then set the stage for even giving more responsibility and more capital to the MDBs. Thank you.
Thank you, Franny. Soha, perhaps you could go next.
Sure. I mean, from our perspective, I think the report, while it touches on a lot of initiatives that we had all been working on for a while, it really got us to think in depth of each initiative, and to kind of, one of the bigger benefits is actually the increased engagement across MDBs in terms of sharing experience, sharing knowledge. And I hope that kind of starts a more in-depth process of this kind of knowledge sharing and cooperation, of sharing innovative ideas, and of also helping educate our shareholders more in-depth into the uniqueness of our situations, and to make the appropriate decisions and trade-offs that are relevant to our individual organizations and aligned to our individual objectives. I think overall, while it's taking us quite a lot of time and effort to look into this, it is well worth it, and we hope that we collectively progress this agenda forward.
Thanks, Soha. Very, very positive message. Andre.
Thank you, Nancy, and again, thanks to the organizers and to the panel for this very fruitful and interesting discussion. I just again, let me finish on stressing that indeed capital and capital management is a core pillar of MDB's strong financial standing. So we obviously pay a lot of attention to it. And obviously it is a pillar of our rating that transposes into our ability to truly serve all of our clients. This is critically important for the EIB that's also serving high-rated countries. Now, very much like Soha, we read the G20 CAF report with great interest. It is focusing the attention. So we are very much committed to analyzing the outputs. I mentioned GEM, so I think it is clearly going in the direction where we intended to go already. So it is giving the right push to us as well. And we are, of course, very supportive of the ongoing balance sheet optimization or the broader balance sheet optimization agenda to further our lending capacity. So it is it is a discussion we are very happy to have, and we are happy to participating in. Of course, again, as has been mentioned earlier, bearing in mind the specifics within which we each individual MDB operate. bearing the specifics in mind of our unique positions. So I'll leave it there. Thank you.
Thanks, Andre. Ajay, your last word.
One Earth, one family, one future. We have to find common solutions. We are together. Specifically, the financial engineering solutions flowing from CAF recommendations must be complemented by a deep look at the MDBs in terms of their operational model and how whatever $1 they lend, how that can be more effective on the ground. Over.
Thank you. That's really an important summary. And Alexia.
Thanks. So 3 quick points. Number 1, there's real and strong momentum on the CAF recommendations. And so we should stay focused on exhausting all that can be done responsibly to boost financial capacity before pursuing other avenues. Number 2, we need to stay vigilant on both the short-term and long-term implementation of the CAF recommendations, and that will require continued work to nurture a strong coalition of shareholders that are coordinating to send clear messages to the MDBs, as well as coordination across the MDBs to really deliver. And then the third point is that financial capacity is critical, but to be seen within a broader context of MDB evolution, as Ajay just said, bringing in vision, incentives, and operational models holistically to meet the challenge of today.
Thanks so much, Alexia. And so I think really what we've heard in this conversation is that this is a critical year going forward, a critical, let's say, 18 months. Shareholders, management, and other stakeholders of these institutions are really going to have to make some critical decisions if the institutions are going to play the role that they need to play given the scale of demands. They have to decide on how to use capital more efficiently in order to increase the amount of finance and impact that they're capable of delivering. Shareholders and donors have to decide where to put additional finance, either concessional finance or more capital. And as both Alexia and Ajay said, these institutions have to figure out how to integrate development goals with climate and other global public good goals, because it has to be done together. These things are not alternatives. I think there's broad agreement on that. So this is a critical year, and I certainly pledge that anything that's the Center for Global Development, and perhaps I can speak for Bruegel too, can do to help advance this process. We are ready to do it. So thank you for really an excellent discussion, to all of the people who spoke, but also to the audience who listened to this conversation. And I'm sure there will be other conversations that will hopefully advance this agenda in the near future. So thanks so much for joining us.